Welcome back, everyone. Next up, we have Futuris. It trades on the OTC Pink sheets under the symbol FTRS and is a human capital management company focused on executive search, staffing, consulting services, and tech services, specializing in verticals such as medical, accounting, finance, information technology, recruitment processing, outsourcing, and legal. Now, the company is committed to building a global HCM company through highly targeted and accretive acquisitions and operational efficiencies. So let's welcome Suresh, Venkat, Board of Directors, and Allan, Hartley, the Board Advisor. Welcome, gentlemen. Good morning to you.
Thanks for having us on.
All right, we look forward to hearing your presentation, and call me back when you're ready for questions.
Great. Thanks, Anna. So just to start off, I'm Allan Hartley. I'm a board advisor to Futuris. My background, just really quickly, I've been in the staffing business literally since the 80s, and major companies such as Robert Half, Kforce, and the like. I was publicly traded CEO for 3 publicly traded companies, 2 in the United States, 1 in Canada. Since COVID, I've been really just becoming a consultant advisor, and I met Suresh through a mutual investment banking person. And we started Futuris in June of 2020, and I'll let Suresh handle it from there.
Yeah, hello everyone, this is Suresh Doki. And I'm with Futuris. I've been around with Futuris from the beginning. And like Allan said, we met in the February of 2020, and he also has been part of Futuris from the very beginning. So Futuris has been founded with the intent of growing it into a large human capital management company. And when it comes to human capital management, the management team with us, and myself included, we have many decades of human capital management experience in variety of forms, from staffing, consulting, high-end consulting, tech services, systems integration, managed services, healthcare staffing, you name it. We've done it all in some size or the other over the last 3 decades, 2.5 to 3 decades. And so the whole goal for Futuris was to acquire a pink sheets company as a shell, and then acquire companies underneath and merge them, integrate them, and grow them. And that's what we've been doing over the last 2 years. We made 8 acquisitions. We currently have 6 subsidiaries in information technology, managed services, healthcare, and legal. And we also have a small RPO division, which we intend to grow. So that's my background, and I'm going back to now to the slides here for Allan. Allan, to the slide presentation for you.
Yeah, I don't see the slides. Do you have it in front of you? I don't have it in front of me.
Go to the tab, slides tab.
Oh, I'm sorry. My fault. Got it. Sorry about that. Okay, I apologize for that, guys. Who we are, we sort of went over that. We're building an international contracting and staffing environment throughout the world. Literally, right now we're in India and the United States, a little bit in Canada, and our goal really is to really do a roll-up strategy of staffing firms and consulting firms. And the reason why investors like this is because we buy companies at a multiple of EBITDA anywhere between 4 to 6 times. And of course, you trade on the market a little bit higher. So you get that arbitrage. And that's why investors have always liked the idea of a roll-up strategy in staffing in any firms, but certainly in the staffing environment, where it's very fragmented industry. There are just a lot of companies out there. You have your big companies, and then you have a lot of small companies out there. But nevertheless, the environment to do this kind of a roll-up strategy is really big. And even the idea of, we don't know what the economy is going to be this year, whether it's going to be up or down. It doesn't matter from the staffing environment because if the economy goes down, a lot of companies start to use contracting work. They may not want to hire people, but they still need work to be done, so they bring in contractors, and vice versa. If the economy goes good, as you can see in the last 2 years, the permanent placement goes through the roof. So that's why it's a really good environment or people to invest in. And you can see just from the public companies that are out there that this is a sector that's not going to go away. In fact, it's only going to go into a bigger, we believe, into a bigger area. The other thing, too, before we get into the slides itself, is that one of the things that makes it us unique is that we're in the professional staffing business. We are going after what I like to say on-demand type clients. What does that mean? We're going after like biotech, biopharm, cybersecurity, accounting practices, IT practices. And we're all over it. There's no geographic boundaries. So it's really service orientated to the on-demand areas. And again, no matter, unfortunately, during our lifetime, those are not going to go away. So the idea of us, of our staffing practices growing is really good because of those kind of on-demand areas we're specifically going after. So anyway, so that is the premise of what we are. As far as the business model is concerned, as you can see in the first slide, you can see some of the areas that we're growing. We're trying to diversify a technology, based staffing company, and you're looking at the strategic and the consolidation that we're doing. Anytime that as you guys all know from the investor community, anytime that you bring in a company, two things really happen. One is you get a bump on the revenue side. As a simplistic point of view, you get a bump on the revenue side where you do cross-selling opportunities, in which we've already seen in our sector. And then, of course, you have SG&A economies of scale. I don't need two banks. I don't need two insurance companies. I just have economies of scale on that. So that 1 and 1 equals 4 is a real number. As you all know, in the investment community, that when you buy companies, that is what happens. And that happens really good with us. The industry overview, as I mentioned before, it's huge. Right now, U.S. companies have over 17 million temporary and contract employees. I'll go better than that. I don't know one company in the United States that doesn't use some kind of a staffing services. I started my career in the 1980s, and it was sort of getting known at that time. But today, it's just a known fact. Especially with COVID that hit, we've seen a lot more remote workplace. We just started, just seeing a lot of things that are happening right now in the economic environment that makes staffing services more conducive. Another reason why companies want to use our services is because they don't have to, there's no liability because there are employees. We're the employee of record. So therefore, there's another reason why companies are now using this. And I mean it when I said, I don't know one company in the United States that's not using some kind of a staffing services. It's just become that big in the U.S. The average is over, as you can see, 3 million of these personnel are employed in projects during any given week, and that probably goes up all the time as well. Even we know that Silicon Valley is laying off some people, as we know today. But you look at the job reports that just came out in January. It's phenomenal what's going on in there too. And anyways, the market opportunity, the healthcare staffing market is estimated to be $45.2 billion by the end of 2026. 50% of healthcare jobs are currently unfilled. In fact, I was just reading, I live in Boston, and I just read something in the Boston Globe where there's more jobs than people, only because there's not enough people out here to be able to fill those jobs. So we're seeing a real, we might say, an uptick in the employment staffing arena. So can you have next slide? Okay. And then our three-phase acquisition strategy is pretty simple as far as this is concerned. Phase 1, we're going to target solutions and staffing companies and robust profits, gross margins, really strong companies, really what it really comes down to. And we're really in the high, what I mentioned before, the on-demand sectors, such as information technology, professional services, accounting and finance, engineering and manufacturing. I'm just reading down here, med tech, pharma, which I told you before, recruiting, processing, outsourcing. And our estimated revenues are around close to, I think they're over 53 million as we speak. On phase 2, we're going to target high margin growth. solutions and staffing companies that can benefit from the merge of a large corporation into a large market. Again, going back to my thesis of when you do buy a company, you have that bump with economies of scale, but more importantly, you get that bump in the revenue side when because you have cross-selling opportunities, which we're already seeing already. Then you fill in geographic to support market penetration. I just want to do phase 3. On phase 3, can you go back again? There you go. You're going to integrate acquired companies to maximize their synergies. We talked a little bit about this with the economies of scale on the SG&A, and then continue focus on expansion. And again, we're trying to fill in where we need. There is no geographic boundaries. The world is flat. So in our view, we even bought a couple companies in India, and everybody's going that way as well. I've even had CPA firms come to me and ask me to build audit practices in India because that's the way the world is heading. On the acquisition criteria, on the deal structure.
I can take this, Allan, if you want.
You got that? Okay, thanks.
So this is Suresh again, back to me. I'm focused, my primary job here is M&A and capital raise. And so for acquisitions, we're looking at companies anywhere from 2 million to 50 million, depending on whether we acquire that as a new line of business as a platform or as an add-on to our existing businesses. For example, if we buy an IT staffing company or an IT tech services company, it will be a small acquisition to what already exists. If we buy a pharma company, it would be a platform that we do not have right now, so it would be a larger acquisition. And we are currently focused on buying the entire company, and we are also open to letting sellers keep some equity as a rolled-in equity, and we acquire majority ownership. But so far, we've done all ownerships, all acquisitions 100% outright. A couple of them as asset deals, but majority of them as stock deals. And they come in with, we have a structure in our acquisition mechanism. We pay about 50% in cash, 50 to 60% in cash. And we have some small earnouts, some portion in stock in Futuris company itself, some in a seller note. So we make whatever we have, whatever resources we have. And depending on the interest of the seller, sometimes sellers are looking to sell and retire. Sometimes they want to take chips off the table and continue doing what they like, what they've been doing for years. So depending on their needs, depending on our interest, we come to some middle ground and we strike a deal. And then the areas we're looking again, like Allan said, IT, healthcare, legal. We have acquired our first company called Keynote in managed services. We have very high gross margins there, over 50% gross margin. So, and recurring services where you hunt now and eat for a long time, like 3-year recurring revenue contracts, sometimes 5-year recurring revenue contracts. So we are putting a lot of push for organic growth in that sector. And I'm also going to focus inorganically to buy another small managed services company with high gross margin. So we have a new tool set to add to the bag. Once again, revenues, we're looking in that 5 to 50 million, 2 to 50 million, depending on it's a platform or if it's a add-on. So now we have, I would like to say that, we crossed the 50 million mark, and the phase 1 of the description in the previous slides is over. We are now more or less in phase 2, where we are focusing on really strategic companies, which are strategic to what we have currently. Strategic could mean new customers from a staffing perspective. From a tech services, it could be a new skill set we acquire, new geography. It could be any of those. It could be anything that gives us the ability to cross-sell to our existing customers, like selling one service that is present in company 1 into company 2 and vice versa. So the cross-selling gives you the ability to make 1 + 1 = more than 2, right? So some of the acquisitions we have done so far, this was done in 2020, October, I believe, Talent Beacon International. This is a recruitment process outsourcing company. We provide recruiting services to clients. So the clients who need recruiters, we provide the bandwidth to them. They don't have to depend on contractor spend, but they also don't have to hire a huge talent pool of recruiters, which they may need for short bursts of time. So this company was acquired exactly 2 years ago, has been growing tremendously fast organically, and has a presence in India, Philippines, and all over the place. So global reach, lots of big blue chip customers. Salesforce is one of them, and there are many in India itself and some here.
And just to dovetail off of that real quickly, they also place, not only do they place people in the United States or these other countries, mostly United States, but they also place people India to India. So if Nike India needs people, they place people there as well.
Yeah. So then our second or third acquisition is a company called Computer Deductions. This company is a government contractor focused on providing tech services, high-end tech and systems integration services to local law enforcement and the federal government. And it's got presence in Orangevale and Santa Ana, California. There's about 50 employees, and we provide services to local law enforcement, airports. A very popular company called IDEMIA. We provide systems integration around IDEMIA, and a lot of Unisys and AT&T, server management and maintenance. That company is growing slowly, but definitely in the right direction. Then we have our fourth acquisition, I believe, is the TASA Group. TASA Group is a legal services, expert witness services company, and it comes under human capital management. And TASA is the oldest, actually the number one oldest company in the country providing expert witness services. I believe it's 67 years old or 57 or some years old, based in Pennsylvania. We've been tracking this company for over a couple of years, and finally we made an offer that finally resulted in a transaction. And the company is doing well, growing, and we're looking to do some small add-on acquisitions in this space. We have some in the pipeline, and hopefully this year we will make at least one more acquisition in the legal space. So just to blow our horn on TASA, TASA was involved in providing expert witness services to many high-profile lawsuits like O.J. Simpson case, then Rodney King case in California. There were many high celebrity cases where this company provided expert witnesses to the lawyers presiding in those cases. Then another acquisition we did was in health care services space, physical therapy services specifically to home health agencies in Broward County and one more county in Florida, where we have a good presence in two of those counties. We initially started with Health HR as a small platform, but it came with the right management, and we put in some good management in there, and then did a couple of small add-on acquisitions on top of Health HR. Merged, there were asset buys that were merged into Health HR, and we maintain the DNA and the branding of Health HR currently. We have another acquisition in the pipeline, another small one, but in the pipeline to grow Health HR geographically right next door, and uses a little more customer base and a little more geography to cover. And that's also in the physical therapy, occupational therapy, and speech therapy space. Organically, we are adding a few customers into Health HR. Our management has a lot of experience in medical staffing, including myself and the president of the company. So we have organically, we are growing it by getting on vendor managed services. We have a couple of targets that have accepted our verbal proposal and a small email proposal. So we are hoping to sign contracts with them, and then we have the recruiting bandwidth to expand on those contracts. That should happen in this quarter. Acquire is another acquisition we did, I believe, June of 2021. Allan, you want to speak to this? You're running this business.
Yeah. Akbar is a pure staffing play where our recruiters are based out of India and our customers are here in the United States. And some major Fortune 500 companies that we make placements in, all in the IT space. We actually bought another company that was spun out of a private equity group to Akbar, and it's probably one of our biggest divisions right now, probably running close to 15 million in revenues. But more importantly, it's just growing tremendously. We just hired a strong leader out there to really get into the human resource IS business. And he's picked up some major clients as well. So we're poised to take that to, we're looking to actually get to hopefully a $20 million run rate by the end of this year by the growth that we're seeing. We just picked up, like I said, we have some really good business development people. More importantly, we have a really strong team of recruiters in India that help augment all the clients that are here in the United States. So we're looking for tremendous growth in this sector.
And then we have Cadent Technologies, which I mentioned in the beginning when I was speaking like 10 minutes ago. This company does systems integration, value-added reselling, and managed services. The managed services is a high-margin growth sector with a lot of recurring services, minimum of 3-year contracts. We acquired the company, I believe, in January of 2022. It's exactly about a year back. So we are slowly scaling down the low-margin value-added reseller business and increasing the managed services business. We have beefed up the sales force on this company through outsourced sales mechanisms to increase revenues on the managed services. We expect to see some good results in this quarter. And we have relationships with many service providers, and their services is what we resell to our customers packaged as managed services. And this company has the ability to service clients nationally, although they're currently located in Minneapolis. And we have 50 plus customers in the managed services arena, and all of them are currently in the 200-mile radius of Minneapolis. However, we have the ability to service clients nationally. And so in our growth strategy, we already covered this between Allan and I. We are looking to increase sales through cross-selling and strategic acquisitions to acquire new geographies and new customers. And our acquisition strategy has some combination of cash, equity, and earnouts, which we talked about. We also have expertise in the employer of record services business. We have not leveraged on that yet. We have an acquisition planned in the second quarter of this year. It's an employer of record service business doing about 30 million revenue. We plan to acquire it in the second quarter of this year.
Kalyan is our president, and you can see his background. Unfortunately, he couldn't be on this call because he's actually traveling, believe it or not, in India, looking at our companies there. But he's got some tremendous operations experience, and I've worked with him closely on the portfolio companies. So, like I said, unfortunately, he's not here, but he is traveling. But you can see his background. Some of the investment highlights. Just one thing before we just finish this off. Just to know our organizational structure. We have the holding company, the PubCo, Futuris, and underneath that we have the wholly owned subsidiaries. And we did it that way for a couple of reasons. One is, how do I compete? How does anybody compete against really like Manpower, Robert Half, any of those major $6 billion companies? You really can't, because they have so much market share, and more importantly, they have so much infrastructure. However, you can compete with them if you're a network of boutiques. And that's our concept, is that we are a network of boutiques that can go after their market, basically swim in our lane, and that can create a really good company that can compete with anybody. All right, and that is the way that we work it out. So we have the economies of scale at the PubCo. We're in the process of doing all that, and then of course you have what I call these these subsidiaries keep their DNA. And what does that mean? They keep their branding, they keep the way they're doing business. Similar like General Motors, you have General Motors underneath, you have Chevy, Buick, and whatever you have out there. It's similar to that, only they're in different sectors of the economy. As far as the investment highlights, you can see there, it's again, this is a very highly fragmented market, which makes it very attractive for investors because you can get that arbitrage of the way we're buying companies and the way the public market valuations are. Then the Futurist thinks a little bit differently, assembled an acquisition strategy. So I think you get the whole picture of what we are about and also our organizational structure. Is there, I think we have to go back and get this lady here, Anna. Yeah, Anna's there. Yeah, go ahead. Good.
Awesome. Are you gentlemen ready for some questions?
Yeah.
Okay, great presentation. Now, you mentioned this earlier in your presentation, but let's get some more details about some acquisitions you have planned for this year.
Suresh?
Yes, definitely. So I have, like I mentioned just now, we have an employer of record services company doing about 29-30 million revenue. As of last year, that acquisition is planned for next quarter. We have a small, this also I mentioned, we have a small physical therapy company we're acquiring in Florida. The letter of intent has been sent to them last week and we are waiting for an acceptance. We gave them a price that they requested, so we're asking price, so we feel good about it. And also Allan went and met them in person, I believe last month, and things went well. You know, there is a lot of synergies and mutual interest. So these are the two acquisitions planned up for these 2 quarters. I have a healthy pipeline of 50 companies, but I don't plan to pursue them now until we raise capital and finish these 2 acquisitions that we have planned so far.
Great. Sounds fantastic. Let's talk a little bit about growth for 2023. What are some of your focus areas?
Yeah. So like I have been saying this, our growth strategy is two-pronged approach, organic, inorganic. Organic is growth through sales efforts. Inorganic is through acquisition. So we just went through the 2 acquisitions that I have planned, which I hopefully will successfully conclude. And more in the pipeline will be added for 3rd quarter and 4th quarter, but that is a little ways away. That is one growth strategy. Second growth strategy, which I have a lot of experience over 20 years, is medical staffing myself. So we are bringing on a lot of vendor managed services contracts into health HR as we speak. And we have the bandwidth back in India, hundreds of recruiters, not hundreds, tens of recruiters, over 100 recruiters that can staff these contracts. So these are the 2 strategies that I have employed currently, and that will change. We'll add more to it. Managed services, the high margin managed services. We hired a sales company to put steroids into the sales engine. So these are the 3-4 different strategies right now for growth.
Yeah, just to dovetail off of that, there's only 2 ways we're going to grow any company, really. It's through mergers and acquisitions, which Suresh and I are doing. And then, of course, organic growth. And it's usually through a horizontal and vertical strategy. Horizontally, by getting us into more markets, and vertical, by selling more verticals into those markets.
Great. Are you guys going to be branding your company to Futuris? Can you talk about that?
Yeah. So... Yes and no. So we have companies like, for example, Accor. When we acquired it, Accor had a small brand name for itself and some recognition for itself. Then we did a an asset buy from a private equity called Savantis. We bought a bunch of assets, $12 million worth of revenue into that entity. Savantis had to go because they kept their name. They just sold us assets. So we managed Accor's brand as Accor. We do not see a need to change the branding for Accor because that would be very difficult to push into the market. But we are going to semi-brand it. We'll call it Accor, a Futurist company. So our name is out there all over the place, and all our marketing efforts, we have these brand names that we carry that we throw into the market, and people will get used to seeing that. Managed services, Cadence, we eventually, might change our name to Futurist. TASA is a legal services company. It's very highly sought after company. I mean, people in the legal industry, everybody knows TASA. The moment I mention it, anybody, they know it. So there is no need to change it to Futuris, although we do mention that TASA is a Futuris-owned company. So we're going to brand, we're going to throw the Futuris name in there, but we're going to maintain the DNA of the existing acquisitions that we have so far, and eventually figure out if we need to totally take off those names and put Futuris name in there. But as of now, we are not doing that.
Yeah, again, it's also a market strategy as well for us to compete in the marketplace. So, and they already have their branding, they already have their clients, they already have their contracts already set in their names. So it's hard to make that change. As Suresh says, though, we keep the DNA of their company, and more importantly, we do that economies of scale back off. So all the back office is centralized, but it's just the selling and the branding is not.
Okay. And how do you currently merge your companies, and to what extent?
Yeah, the economies of scale, right? We've mentioned that. So basically, that's what we do. The merger is mostly on the back office, is only on the back office side, which means the workman's compensation, general liability, benefits, payroll, accounting staff, all of that in the back end is merged. The front end of the company, which is the sales and the branding and delivery, they're all kept separate in those entities, in the subsidiary entities. So that's all we're doing, getting some economies of scale for now.
And then also on the revenue side of the business, again, I simplify, right? Revenue expenses, right? So on the revenue side of the business, we help them grow in the sense that we give them marketing tools, like we do marketing campaigns, email campaigns, things like that we put in place to actually grow their business. Nobody buys a business to be stagnant. You want to grow. So we come up with different strategies to do that.
Yeah, and cross-selling, I forgot to mention. So we allow or we facilitate salespeople from one company to sell into the existing customers of another company, so that you can maximize benefits of cross-selling.
Great. Let's talk uplisting. Do you have any plans for that?
Yeah. So currently we're Pink Sheets. We are looking to finish up our audits and get into becoming a fully reporting company. So we have SEC reporting in place. So that's our next step. Then once we do that, we're looking to uplist to NASDAQ or NYSE. It's too early to speak now, but right now our first step is to go to OTC QB and become fully reporting. That's our goal for the end of next quarter. And before the end of the year, hopefully we will have started the process for getting on NASDAQ or NYSE.
And Simeon Wahlberg wants to know, when will you be current on your SEC filings?
Hello, Simeon. We should be current on our filings.
I would say by the end of the first quarter, second quarter.
No, we're current on our filings. I think he means when will we become fully reporting? That should be next quarter.
Okay, right. I'm sorry. Okay.
Filings, we're current. We're not behind on any filings.
Okay, thank you for that. Dan Hall wants you to talk a little bit about your revenue model. He asks, do you get paid for the staffing? And if a company decides to make them permanent, do you get another fee?
Yeah, the way that we work is there's three things that actually take place in a staffing company. One is contract, which is bill rate minus pay rate minus payroll burdens. So there's a bill rate, there's a pay rate, it's an hourly, usually done by the hour. So we make that. We make what's called that gross margin. Bill rate minus payroll burdens equals gross margin. That is where we make our money. On the permanent placement side, any fees that we charge, we usually charge anywhere between 20-25% of first year's salary. That is our fee. And then there's the third thing, which is contract to perm. A lot of companies want to try them out. If they like them, they bring them on board. And there's a fee for that. I hate to use the word liquidation fee, but that's really what it is.
Okay. And Richard Martin asks, do you provide intern services for various trainees or students?
No, we do not.
Right now, no.
Okay. Well, gentlemen, do you have any closing remarks for us today?
I just want to thank everybody for coming on this. We appreciate it. And please, call us or email us or whatever. We'll follow up anyways in the next few days, because this is a great opportunity, we feel. Obviously, because we're here, but more importantly, it's what's happening right now in the environment, in the economic environment. This is a good company to invest in.
Wonderful.
Suresh?
We really, yes.
Thank you all. Thank you. I don't have anything more to add. I just want to thank you all for listening and understanding and knowing our company. And hopefully we'll see you become a part of the family as an investor or any scope. Thank you all.
Wonderful. Thank you, gentlemen, for your time and your presentation. We look forward to you coming back soon with some updates.
Thanks, Anna. We appreciate it.
All right, everyone, we're going to take a quick break. We'll be back at 10:50 Eastern Time with our next presenter. We'll see you soon.